Hello students, welcome to EPG Pathshala. I am Ritesh Verma from Maharaja Agrasen College, University of Delhi. Today we are going to talk on module Traditional and Modern Accounting System from paper Accounting and Financial Analysis. Learning objectives. After studying the module, students will be able to get an idea about the meaning of accounting and the different types of accounting systems. Further, a detailed idea can be gathered about the traditional as well as modern accounting system and comparative evaluation of both the systems. Introduction. Transactions refer to the events in which the business is engaged in day-to-day business and conduct business by dealing with the outside world. The interaction with the outsiders lead to the creation of certain monetary as well as non-monetary effects, which need to be noted down in proper order for the purpose of future references. The recording of transactions in the books of accounts is termed as bookkeeping. It is clear that an information is useless unless and until it is communicated to the management and to the interested users. The process of recording, summarizing, analyzing, and interpreting the useful and meaningful information is termed as accounting. Accounting is a process whose main function is to provide quantitative, financial, and understandable information to the management so as to help in making certain important economic decisions. Meaning of accounting. Accounting is the business language which communicates the working of the business in quantitative or monetary terms to those interested in the business. It is the process of identifying, recording, summarizing, analyzing, interpreting, as well as communicating the required information to the interested users of the organization. According to AICPA, accounting may be defined as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are in part at least of financial character and interpreting the results thereof. Different accounting systems. In order to make accounting more effective, that is, in order to improve the effectiveness of accounting information, it is important that the information so presented is reliable, accurate, and comparable. For this purpose, accountants follow a certain set of accounting principles and conventions along with some predetermined rules of debit and credit. This means that for entering the transactions in the books of accounts, certain rules are to be followed by the accountants. Accounting is an old concept. It was even practiced in around 4000 BC in Babylonia and Egypt, where the transactions such as payment of tax and wages was recorded on clay tablets. But with the passage of time, accounting system faced many changes and advancements, and the system of recording the transactions changed from time to time. There are two approaches for recording the transactions in the books of accounts. One, traditional accounting system, and two, modern accounting system. Traditional accounting system, also known as English approach, is the method of accounting where the accounts are divided into various categories and on the basis of which the rules for debit and credit are applied on different accounts respectively. Types of accounts could be broadly divided into two parts: impersonal accounts and personal accounts. Impersonal accounts can be further subdivided into real and nominal accounts. Real accounts can be further subdivided into tangible and intangible accounts. Now, personal accounts could be of natural personal accounts, artificial personal account, or representative personal account. Impersonal accounts. Impersonal accounts are the accounts which are not associated to any person directly or indirectly. It is further divided into real and nominal accounts. Real accounts. The account which is related to the recording of financial transactions of the business in terms of property or asset. The real account is divided into tangible and intangible accounts. Tangible accounts. Tangible account is the account related to the assets of the business which can be touched, seen, and felt. Example, machinery, table, building, etc. Intangible account. Intangible account is the account which is concerned with those assets which cannot be seen, felt, touched. For example, goodwill, patent, and copyrights, etc. Nominal account. All the transactions connected with the expenses, incomes, gain or loss of the business are grouped under the nominal account. For example, rent account, interest account, etc. Personal accounts. It refers to the accounts of all the persons or individuals with whom the business transactions in the entire course of the business take place. It is further classified into three types: natural, artificial, and representative. Natural. All individual persons with whom the business transactions in the entire life are grouped under one head are called natural person accounts. For example, Rowan's account, artificial account. This is an account included in the financial dealings of the business with the artificial person, bodies created by law. For example, firm's account, bank's account, etc. Representative. Representative person's account include the accounts that act as a representative for a person or individual. Outstanding expenses or accrued income accounts form a part of this category. For example, accrued rent is a personal account representing rent received by the business. Two types of accounting systems: traditional system and modern system. Under traditional approach, accounts are mainly divided into personal, real, and nominal accounts. Personal accounts deal with the individual with which the business transacts. Real account is concerned with the property or assets of the business. Nominal account includes all the expenses, losses, gains, and profit of the business. The general rules of debit and credit concerned with the traditional approach are discussed now. Personal account. In case of personal account, debit the receiver, credit the giver. In case of real account, here the rule: debit what comes in, credit what goes out is followed. Nominal account. Here the rule applied is debit all expenses and losses, credit all incomes and gains. The rules mentioned above are tabulated and discussed here again. In case of real account, debit what comes in, credit what goes out. In case of personal account, debit the receiver, credit the giver. In case of nominal account, debit all expenses and losses, credit all incomes and gains. Now let us discuss some examples. Example 1. Transactions. Sale of building for rupees 3 lakhs. Analysis. On starting with the analysis, the first step is to find the number of accounts involved. Here, cash account and building account are involved. Further, the nature of building account being the real account and that of cash account also real account. On applying the rule to the real account, debit what comes in, credit what goes out. We conclude that cash will be debited as it is coming in, whereas building will be credited as it is moving out of the business. So entry will be made as following: cash account debit rupees 3 lakhs to building account rupees 3 lakhs. Transaction number 2. Dividend received in cash rupees 50,000. Analysis. On starting with the analysis of the transaction, it is clear that the accounts involved are dividend account and the cash account. The cash account being the real account, whereas dividend account being the nominal account. On applying the rule to the real account, which is cash in this case, debit what comes in. We conclude that cash account will be debited. Further, on applying the rule to the nominal account, dividend in this case, credit all incomes and gains. We conclude that dividend account will be credited. So entry will be made as following: cash account debit rupees 50,000 to dividend account rupees 50,000. Now transaction number 3. Received cash from Rajesh rupees 30,000. Analysis. It is clear that the two accounts involved are the cash account and the Rajesh account. The nature of cash account is real, whereas the nature of Rajesh account is personal account. Real account rule, debit what comes in, is applied on the cash account, thereby debiting the cash account by rupees 30,000. On the other hand, Rajesh being a personal account is credited, as the rule for personal account says, credit the giver. So following entry will be made: cash account debit rupees 30,000 to Rajesh account rupees 30,000. Transaction number 4. Salaries of rupees 60,000 paid through check. Analysis. The transaction depicts that the business has paid all the salaries through check. That is, cash is not involved in the transaction. As a result, the two accounts involved are salaries account and bank account, because payment made through check. Salaries account is classified as nominal account, and on applying the rule, debit all expenses and losses, we debit the salary account with rupees 60,000. On the other hand, as bank is a personal account and as the rule says, credit the giver. Bank account will be credited with rupees 60,000. So following entry will be made. Salaries account debit rupees 60,000 to bank account rupees 60,000. Quick revision. The rule for personal account says debit the receiver, credit the giver. Real accounts rule is defined as debit what comes in, credit what goes out. Rule for nominal account: debit all expenses and losses, credit all incomes and gains. Modern accounting system: with the ever increasing and growing economy, the business houses are dealing with a large number of customers and trying to expand their business globally. In such a case, it becomes difficult to follow and practice the traditional approach. Therefore, the modern approach is being followed by most of the organizations. According to the modern approach, the transactions are recorded keeping in mind the accounting equation, and efforts are made to maintain a balance between both sides of the equation. Before moving ahead, it is important to understand what an accounting equation is. Accounting equation is assets is equal to liabilities plus capital. Here assets means everything a company owes to itself. It includes cash, building, suppliers, land, amount receivables, etc. Liabilities means what a company owes to the outsiders in the form of short-term or long-term debt. It means everything which a company is liable to pay back is a liability. Example: salaries, rent loan, loan repayment, etc. Capital: it refers to the owner's equity. It belongs to the business as a whole. It is the amount the owner has invested in the company. The accounting equation is a statement which depicts the equality between the debits and credits. The rules are different for debit and credit on the basis of the nature of the account. Therefore, the accounts are classified into 5 categories under the accounting equation approach or modern approach. Here, types of accounts are of following types: assets, liability, capital, expenses or losses, and revenue or gain. The fundamental rules of debit and credit are as follows. Asset account: increase in asset is debited, decrease in asset is credited. Liability account: increase in liability is credited, decrease in liability is debited. Capital account: increase in capital is credited, decrease in capital is debited. Expense or losses account: increase in expenses is debited, decrease in expenses is credited. Revenue or gain: increase in revenue is credited, decrease in revenue is debited. Examples: transaction 1: introduced rupees 3 lakh as cash and rupees 40,000 by stock in the business. Analysis: the asset side of the equation is increased by rupees 3 lakh cash and by rupees 40,000 stock. As a result, there will be a capital increase of rupees 3 lakhs 40,000. On the other side of the equation, assets is equal to liability plus capital. Cash plus inventory is 3 lakhs plus 40,000, that is 3 lakh 40,000, and liability plus capital side is 3 lakh 40,000. So assets is equal to liability plus capital. This example shows the effect of the transaction on the accounting equation. Rest of the examples will highlight the debit and credit rules in respect to the modern approach. Transaction number 2. Opened up a bank account with rupees 4 lakhs. Analysis. The two accounts involved are the cash account and the bank account, both being asset in nature. And as the rule highlights, an increase in asset is debited. Therefore, bank account is debited. As there is a decrease in cash, cash being an asset will be credited because decrease in asset is credited. So entry which we will make is bank account debit rupees 4 lakhs to cash account rupees 4 lakhs. Now transaction number 3. Purchased furniture from Shamlaw and Sons for rupees 60,000. Rupees 30,000 paid in advance in cash. Analysis. Purchase of furniture means increase in asset of the firm by rupees 60,000. Therefore debited. Further, only a part of money, rupees 30,000, is paid to the supplier. Therefore, cash will be reduced by rupees 30,000. Only as a result, cash account will be credited as decrease in asset is credited. And the liability to Shamlaw and Sons increases by rupees 30,000, that is 60,000 minus 30,000. The unpaid amount by the business. An increase in liability will be credited. Shamlaw and Sons account will be credited. Following entry will be made. Furniture account debit rupees 60,000 to cash account rupees 30,000 and to Shamlaw and Sons rupees 30,000. Now transaction number 4. Cash withdrawn by owner of rupees 30,000 from the business. Analysis. The two accounts involved are cash and capital. The cash is taken out of the business, therefore decreasing the cash account by rupees 30,000. Decrease in asset is credited, therefore cash account will be credited. By doing so, the capital of the business will be affected. It will decrease by rupees 30,000 and therefore will be debited. So we'll make following entry: capital account debit rupees 30,000 to cash account rupees 30,000. Quick revision. Under modern accounting system, the rules for different accounts are different. For asset account, increase is debited and decrease is credited. For liability account, increase is credited and decrease is debited. For capital account, increase is credited and decrease is debited. For income or gain account, increase is credited and decrease is debited. For expense or loss account, increase is debited and decrease is credited. Traditional versus modern accounting systems. Accounting is at its evolving stage, where, with the changes in the social, economic, political, and legal environment, the accounting concepts and conventions are modified to meet up the required changes. This modification has led to the advancements and changes in the methods of recording of the transactions in the books of accounts. Now, with the passage of time, the accountants are free to follow any of the accounting styles or any of the accounting methods for recording purposes. It is up to the accountant to either choose the cash basis of accounting or accrual basis of accounting. After making such a decision, the next step is to decide upon which system to apply while recording the transactions. As discussed now, there are two systems of accounting: traditional, also known as English approach, and modern system, also known as an American approach. The debit and credit rules are different according to the types of system followed. It should be noted that there is a same effect on the transaction whether traditional approach is followed or the modern approach is followed. The end result will be same irrespective of the type of accounting system followed. To enumerate this, certain examples are comparatively evaluated by using both the systems. So students, let us summarize what we have learned in this module. Accounting is as old as the currency and has been used since 4500 BC in Egypt and Babylonia, where the transactions were recorded on clay tablets. This process of recording the transactions in the books of accounts is termed as bookkeeping, as it is known that the recorded data is of no use unless and until it is presented in the form of understandable, comparable, reliable, and relevant piece of information. The recorded data is analyzed and presented in front of the management so that they can take certain economic decisions relating to the business. This process is termed as accounting. Accounting is an evolving process, which means that the system of recording the transactions in the books should be changed and modified with time so as to meet up the change in the environment and maintain flexibility. Keeping this in mind, the accounting concepts and conventions are modified from time to time along with the change in the system of bookkeeping. The accountants now have an option of either choosing the traditional accounting system for maintaining the records or to go for modern system of accounting. It is worth mentioning that there will be no change in the transactions to be recorded in the books, irrespective of the accounting system followed. For different accounting systems, different set of debit and credit rules are framed. Under the traditional approach, the accounts are classified as real, personal, and nominal. The rule for personal account says debit the receiver, credit the giver. Real accounts rule is defined as debit what comes in and credit what goes out. Whereas rule for nominal account, debit all expenses and losses, credit all incomes and gains. Under the modern system of accounting, the accounts are divided into 5 categories of assets, liabilities, capital, expenses, and income. Modern system of accounting is based on accounting equation. The rules under the modern approach are different for different accounts. For asset account, an increase is debited and decrease is credited. For liability account, an increase is credited and decrease is debited. For capital account, increase is credited and decrease is debited. For income gain or increase is credited and decrease is debited. And for expense or loss, an increase is debited and decrease is credited. It can be concluded that with the evolution in the business environment, accounting as well faced many evolutions for the ease of recording the transactions in the books of accounts. And this evolution added to the new advanced methods of bookkeeping and accounting, which acted as a helping hand for the management as well as the outsiders. Thank you.